The Roman Empire didn't collapse in a day. It was slowly debased into irrelevance, one clipped coin at a time. We are now witnessing the same structural decay of the world's reserve currency. We look at inflation as a simple rise in prices, but that definition misses the core mechanism. What we call inflation is not the disease, it's the fever. The disease is the systematic devaluation of the currency itself. The biggest currency devaluation in modern history isn't a sudden event you'll see on the news. It's a structural policy choice playing out in slow motion across every major central bank's balance sheet. It's the only politically viable solution to a mathematical problem, the impossible weight of sovereign debt. This is the modern mechanism for a soft default. We'll trace the policy path that leads from the end of the gold standard to today's multi-trillion-dollar balance sheets, showing why this devaluation is not an accident but an inevitability. We need to redefine the battlefield. The common definition of inflation focuses entirely on the symptom, rising prices for goods and services. But if you treat the symptom without addressing the cause, you'll never solve the problem. The cause is currency debasement. It's the deliberate reduction in the purchasing power of a unit of money. Historically, this was a physical act. The Roman denarius, the empire's standard silver coin, saw its silver content drop by roughly 83% over 2 centuries. Emperors clipped coins, mixing in base metals to fund wars and public works without raising taxes. The result wasn't just higher prices, it was a complete breakdown in the trust and function of money, contributing to the empire's economic chaos. Today, we don't clip coins. We have a more sophisticated system. We call it fiat, money by government decree, backed by nothing but trust and policy. The modern equivalent of coin clipping is balance sheet expansion. When a central bank like the Federal Reserve engages in quantitative easing, it isn't just stimulating the economy, it is creating new currency units and using them to purchase assets, primarily government debt. This action directly increases the monetary base, the foundation of all money in the economy. It dilutes the value of every existing dollar in circulation, just as adding lead to silver diluted the denarius. This reframes every contemporary economic debate. We're not really arguing about whether consumer prices are rising 3% or 6% this year. We're arguing about the quality of the currency itself. And this is the part most people miss. Are we willing to accept a gradual, managed decline in its purchasing power to avoid more painful alternatives? The discussion about inflation fighting is often a discussion about managing the pace of debasement, not stopping it. Because to stop it would require confronting the original sin that made debasement necessary in the first place. And that leads us directly to the sovereign debt trap. The motive for systematic devaluation is not hidden. It's a matter of public record, visible in the debt statistics of every major economy. Global sovereign debt is approaching $100 trillion. For nations like the United States, the United Kingdom, and Japan, debt to GDP ratios now consistently exceed 100%. This creates a mathematical bind. When debt reaches this scale, governments are left with only 3 policy choices. Each is politically toxic, but one is always chosen because it's the only one the system can absorb. The first choice is outright default. A government simply declares it cannot and will not pay its debts. The immediate consequence is financial collapse. The nation loses access to credit markets, its banking system implodes as it writes down sovereign bonds, and economic activity ceases. It's a political and economic suicide pact. No established power willingly chooses this path. The second choice is austerity. This means the government sharply increases taxes and cuts spending to generate budget surpluses to pay down debt. The economic consequence is immediate contraction, recession, or depression. The political consequence is almost always unrest. History shows that austerity imposed on a large scale leads to instability. It is a recipe for voting governments out of power or worse. It transfers pain directly and visibly to the electorate, which makes it historically unsustainable. This leaves the third choice, devaluation. It is the soft default. This is where the system quietly breaks. Through the mechanism of currency dilution, a government can reduce the real value of its debt burden without ever missing a nominal payment. If you owe $100 trillion and you engineer a scenario where the purchasing power of each dollar is cut in half, you've effectively halved your real debt load. The creditor still gets their $100 trillion, but what those dollars can buy has been diminished. The key insight is that this choice isn't primarily about economic theory. It's about political survival. Devaluation is a diffuse, slow-moving tax on everyone who holds the currency, particularly those who hold cash or fixed income assets. Its effects are felt over years, not in one brutal fiscal budget. The pain is distributed so widely and so gradually that it rarely sparks immediate revolt. For a political class facing an impossible mathematical debt burden, it is the only viable exit. The policy path is set. The question is no longer if, but how it will be executed. And for that, we must look at the modern minting press, the central bank balance sheet. So if devaluation is the chosen policy, what does the modern execution look like? It looks like a balance sheet. This is where the theory meets the ledger. Quantitative easing is often discussed as economic stimulus, a tool to lower long-term interest rates. But that description focuses on the effect, not the essence. At its core, QE is sophisticated currency creation. The central bank decides to increase the number of monetary units in existence. It does this by purchasing assets, overwhelmingly government bonds, from the financial system. It doesn't pay with money it has saved up. It pays by creating new digital bank reserves, crediting the seller's account out of thin air. The scale of this operation is what makes it the modern equivalent of the Roman mint. Since the global financial crisis, major central bank balance sheets have expanded from a small fraction of their economies to dominant financial forces. The Federal Reserve's assets grew to about 35% of U.S. GDP. The European Central Bank's balance sheet reached roughly 65% of the Eurozone's GDP. The Bank of Japan's assets dwarf its economy, approaching 130% of GDP. These aren't temporary emergency measures that quietly reverse. They represent a permanent structural increase in the monetary base, the foundation of all money and credit. The mechanics are critical to understand. When the central bank buys a bond, it swaps an interest-bearing asset for a non-interest-bearing one, bank reserves. This directly increases the amount of base money in the financial system. Now here's where the real transfer happens. Initially, this new liquidity doesn't flow to Main Street to bid up the price of groceries. It remains trapped within the financial system where it chases existing financial assets, stocks, bonds, and real estate. This is why we've seen such a stark divergence between asset price inflation and consumer price inflation for over a decade. The wealth of those who own assets skyrocketed, while the cost of living for those who don't remained relatively contained. This creates a powerful illusion, the wealth effect. Policymakers theorize that rising asset prices make people feel richer, leading them to spend more and stimulate the broader economy. But the historical precedent is clear. Every fiat currency in history that has embarked on this path of balance sheet expansion has followed it to the same conclusion. The increased quantity of money units inevitably seeks an equilibrium, eroding the purchasing power of each unit. The expansion itself is the act of debasement. We are watching the minting press work in real time, not with silver and lead, but with digits on a central bank server. To understand why this hasn't exploded yet, we need to talk about velocity. This leads to the most common counter-argument, and it's a valid one. If this new money is being created on such a vast scale, why hasn't it triggered Weimar Republic-style hyperinflation already? The answer lies in a component of the monetary equation that often gets overlooked: velocity. The classic equation is money supply times velocity equals price level times output. We've been focused entirely on the explosive growth of the money supply. But since 2008, the velocity of money, the rate at which a dollar changes hands in the real economy, has collapsed to historic lows. Think of the financial system as a complex network of pipes. The central bank is pumping vast amounts of water, liquidity, into the system. But if the valves leading to the real economy, consumer and business spending, are mostly closed, the water simply pools up in reservoirs. Those reservoirs are bank balance sheets, money market funds, and financial asset markets. The water pressure builds, but it doesn't flood the town. This is what we've witnessed. The new money has been used to bid up the prices of existing assets or sits as excess reserves, not to fund a frenzy of new consumer purchases. This collapse velocity has acted as a temporary dam, holding back the full inflationary impact of the money supply expansion. It's why we got asset price hyperinflation long before we saw sustained consumer price hyperinflation. Here's the critical pressure point. A dam is not a permanent solution. It's a structural feature under constant pressure. Velocity is not a magical independent variable. It is a function of confidence and economic behavior. When confidence in the future is high, people and businesses spend and invest money quickly. When confidence is low, or when the system is flooded with liquidity that has no productive outlet, money stagnates. The historical pattern is that velocity eventually normalizes. It may take a catalyst, a loss of faith in the currency, a supply shock, a geopolitical event, but the dam breaks. The water that has been pooling behind it finally finds its way into the broader economy. We are in the phase where the water level behind the dam is at a record high, and the structural weaknesses in the dam itself are becoming more apparent. The monetary expansion has already happened. The devaluation has already been engineered in the ledgers. We are simply waiting for the full effects to manifest in the prices of everyday goods. This time lag between cause and effect is what allows the process to continue. It lets people believe the old rules still apply, even as the fundamental reality of their currency is being rewritten. This mechanism of systematic devaluation does not affect everyone equally. It is not a random event, but a predictable engine for wealth transfer. Understanding who benefits and who loses is crucial, because it reveals the true political economy behind the policy choice. Devaluation systematically transfers wealth from savers to debtors. It is a silent confiscation from anyone who holds their wealth in the currency itself or in promises denominated in that currency. The losers are clear: fixed income retirees living on pensions or bond coupons, insurance companies, and pension funds with long-term liabilities. Anyone who holds cash in a savings account is watching the real value of those savings erode year after year. Their loss is not a market fluctuation. It is a direct consequence of the monetary system's design. This transfer isn't confined within borders. According to the World Bank, between 2022 and 2024, developing countries saw net debt outflows of about $741 billion. They paid more in interest and principal to foreign creditors than they received in new financing. The wealth flows from the periphery to the core of the financial system. Conversely, the winners are those who own assets that are not claims on the currency, but claims on real things. This is the hidden mechanism at work. Owners of productive real estate, equity in companies, and commodities see their holdings rise in nominal price. This isn't necessarily because the underlying asset became more valuable overnight, but because the measuring stick, the dollar, is being shortened. Their wealth is preserved and often amplified in real terms. The biggest beneficiary, however, is the sovereign debtor itself, the government. As the currency's value declines, the real burden of its massive debt shrinks. It can service its obligations with cheaper dollars. This isn't a conspiracy, it's arithmetic. There is a clear historical example. After World War II, the United States carried a debt-to-GDP ratio even higher than today's. It didn't pay that debt down through surpluses, it inflated it away. Through a combination of financial repression, keeping interest rates artificially low, and allowing periods of higher inflation, the US effectively halved the real value of its debt burden within a decade. The creditors were paid back in full, but with dollars that could buy far less. This was the soft default in action, and it worked precisely as intended to restore fiscal space without political revolt. The system is designed to make this transfer appear as a natural market outcome, but the driving force is policy. The central bank, by controlling the price and quantity of money, sets the stage. The result is a reallocation of resources from the passive currency-based saver to the active asset-holding borrower and the sovereign state. It is the quietest and most politically sustainable form of taxation ever devised. But this story isn't confined to one nation's balance sheet. The US dollar's unique role means its devaluation is not a domestic event, it's a global export. This is where the dollar stops being a national issue. Is this just a US dollar story? The answer is a definitive no. The devaluation is already measurable. By mid-2025, the dollar index had fallen roughly 11% in the first half of the year, its steepest first-half drop since 1973. In a globalized financial system, no major currency operates in isolation. The US dollar's status as the world's primary reserve currency, the medium for international trade, the benchmark for commodities, and the foundation of global banking makes its devaluation a contagion event. When the core currency is debased, the entire system feels the pressure. This creates what economists call the impossible trinity for other nations. A country cannot simultaneously maintain a fixed exchange rate, allow free capital movement, and run an independent monetary policy. It must choose two. For many export-driven economies or those with dollar-denominated debt, letting their currency appreciate wildly against a weakening dollar is not an option. It would crush their competitiveness or explode their debt burdens. The pressure is immediate. Emerging markets face a record $8.2 trillion in debt that needs to be rolled over in 2025. So, they are forced to follow the Fed's lead. To maintain relative stability, they must also expand their own money supply, engaging in their own versions of quantitative easing. They import the policy of devaluation to avoid a worse outcome, a broken export sector, or a sovereign debt crisis. Look at the constraints within the Eurozone. Member nations like Italy or Spain have relinquished their monetary sovereignty to the European Central Bank. They cannot devalue their own currency to gain competitiveness. The only tool left to manage their high debt loads, short of politically impossible austerity, is for the ECB itself to engage in massive asset purchases. This is why the ECB's balance sheet swelled to 65% of Eurozone GDP. It is the necessary systemic response to prevent fracture, effectively devaluing the euro as a whole. Japan provides the clearest view of the endpoint of this policy path. For 3 decades, the Bank of Japan has pursued the most aggressive monetary expansion of any major economy, with its balance sheet now larger than the country's annual economic output. The goal has been to create inflation and devalue the yen to manage its colossal public debt. It is a live experiment in sustained, controlled devaluation. The result is not a series of isolated currency crises, but a synchronized global devaluation. This is the contagion in motion. We are not watching individual currencies collapse like dominoes. We are watching them all slowly sink together in a coordinated effort to manage a synchronized debt problem. The historical parallel is not the 1997 Asian financial crisis, but the 1930s, a period of competitive devaluations where countries raced to cheapen their currencies to export their way out of depression. The key difference today is a degree of coordination and a shared understanding of the underlying debt trap. The devaluation is collective because the problem, the mountain of sovereign debt, is collective. The path is set, and it leads away from the purchasing power of every major fiat currency in the system. History tells us how this phase always ends. If this is the established path, what does the end point look like? History offers several exit ramps, none of them voluntary. The Roman solution was total collapse. The denarius became worthless and trade reverted to barter and commodity-based exchange. The Weimar solution was a complete currency reset. The introduction of the Rentenmark, theoretically backed by land and industrial assets, to halt the hyperinflation and restore a semblance of trust. In 1971, the solution was to break the final link to gold entirely, accepting a pure fiat floating system and absorbing the inflationary consequences. The common thread in each historical exit is a break in confidence. The devaluation cycle continues until the population and the markets no longer believe the currency will retain any future purchasing power. At that point, it ceases to function as a store of value. Today's potential exits are variations on this theme. We see discussions of central bank digital currencies with programmable features, offering the state unprecedented control over money's use in a new system. There is perennial speculation about a revaluation of gold within the monetary system, a modern attempt to reintroduce a hard anchor. Or the exit may simply be a crisis, a loss of reserve status for the dollar, triggering a chaotic scramble for alternatives. The historical record is clear on one point. These transitions are never smooth and are rarely chosen by those in power. They are forced by circumstance when the cost of maintaining the existing system exceeds the perceived cost of change. We are currently in the maintenance phase, managing the pace of debasement to stave off that final crisis of confidence. Which brings us to the practical question. What does this mean for your capital? The traditional 60-40 portfolio of stocks and bonds is structurally vulnerable to currency debasement. Bonds are a promise to be paid in the very currency being devalued. Their fixed coupons lose real value. The goal shifts from nominal returns to the preservation of purchasing power. Historically, hard assets have served this role. Commodities, productive land, and infrastructure represent claims on real resources, not financial promises. Owning a share of a business through equity is a claim on its future profits and assets, which often adjust with inflation. Foreign currency exposure becomes critical, not because other fiats are immune, but because diversification across different debasement trajectories can mitigate risk. The role of gold shifts in this context. This is the practical implication. It moves from being a simple inflation hedge to being a currency alternative, a form of money outside the banking system with no counterparty liability. Debt, paradoxically, can become an asset if it is structured correctly. Fixed-rate debt used to acquire appreciating hard assets creates a powerful hedge as you repay the loan with cheaper dollars. The ultimate protection is owning productive assets that exist outside the purely financial system, assets that generate real goods, services, or income streams that are needed regardless of the currency's name. The systematic devaluation of major currencies is the modern, quiet solution to a mathematical impossibility: perpetual debt growth on a finite base of real resources. This isn't a prediction of a future event. It is the observation of an established, ongoing policy path visible in every central bank's ledger. Understanding this mechanism, the why of the soft default and the how of the balance sheet, is the first and most critical step toward true financial resilience. The historical pattern of fiat currency devaluation is unambiguous. The only remaining variable is the timing of its full and final acknowledgement in the price of everything.